Okay, so welcome to section 4 for mastering inventory. In this section, it looks like we are going to look at the inventory costing for weighted average and moving average method. First thing that I think we need to cover that is what's the difference between weighted average and moving average. Weighted average means you are using periodic method, and under periodic method you know how many units you have, you know what is the cost of it. So at the end of the year you divide the cost by number of units that you have, and you get a weighted average cost of each unit of merchandise you have. But in moving average, as soon as you hear that moving average, that means you know that the company is doing perpetual method, because under perpetual method, the moving average is constantly changing. As soon as you buy a new layer of inventory, the moving average is changing to a new cost. So that's why we call it moving average, because every single time you buy a new layer, the average cost is changing. It's never same. But under weighted average, because we do this under periodic method, at the end of the period, we just divide total cost of merchandise we purchased divided by number of units that we have, and we get a simple, solid weighted average cost for each unit of merchandise. So hopefully that covers that part, so you can kind of remember what does weighted average and moving average method means. And weighted average relates to periodic method, and moving average relates to perpetual method. So the company which uses the periodic method and weighted average costing begins operation in 2018. On January 15th, it purchases 20 units at $6 each. On March 1st, 30 units at $7 each. Then June 1st, 450 units at $5.25 each. And on November 12th, 50 units at $6.25 each. Okay, so what is the company's cost per unit? So because it's a periodic method, we are doing weighted average. So what we are going to do is just multiply number of units that we purchased by dollar amount that we paid, and we get the total cost and different times different layers of purchase. So we add them up. So we see at the end we have $3,500 cost, and we have 550 units total. So divide that, and you get $5 for the 6 cents. And because it's a average costing, so you need to go at least 4 decimals. So 5.4636. The reason you do at least 4 decimals, because you want to get accurate cost of goods sold and also cost of ending inventory. So if ending inventory is 125 units, what is the Philip Cost 2008 ending inventory and cost of goods sold? So ending inventory is 125 units because we did a physical count at the end of the year. Every business is doing that. So at the end of the year, they do a physical count. They got 125 units left times the average cost that we calculated. So that will be $682.95. Therefore, the cost of goods sold will be the difference. So $3,005 available for sale minus ending inventory gives us $2,322.05 cost of goods sold. This is where we call it base. So beginning And what is the beginning inventory here? You see, it says begin operation in 2018. That means the beginning inventory is 0 because it's a brand new company. So beginning plus added equals available less end gives you cost of goods sold. So here is the beginning, 0 plus added. So 0 plus added is available of $3,005 less ending inventory of $682.95 gives us the cost of goods sold. We call this base, BAASE, beginning added available subtract end. So as I said, we're going to use this a lot in accounting. So you just make sure you know those BAASE, so you can plug it in all the numbers in your note paper and get the correct answer in an exam situation and move on to the next question. In the same time, in the module, I have these Excel documents for you, which I have ready here for you. If you go to your module, you will see. You download that Excel document, so you see some of those problems starting this section 4. I have it already in this Excel format. So section 4, weighted and moving average, and then section 5, and then section 6 and 7, and so on. So here in section 4, problem 1, the one that we just did, it's right here in Excel. So you know how many units you have, you know the cost, and here is 120, which we are using a formula. So 6 times 20. Same thing, you use the same formula on every single calculation. And here we go, we just sum them up. And here is the average. So the average is 3,005 divided by number of units. And that gives you the average of $5.46. So this $5.46, normally you go with more decimals. You see that? It's like that. Make sense? 5,436, let's say. And then you save the document so you can kind of see the better calculation. So here, ending inventory is 125 units because of physical count. And this number, the average cost, equals to what? Equals to that highlighted average cost that we have here. And then we go to that cell and we say 125 times, let's say 546, whatever it is, 546.36, and it gives us a dollar amount. Ending inventory $683. And then we can easily also have the cost of goods sold, which is the difference of 550 minus 125, right? Those are cost of goods sold. And and the dollar amount is, let's say, $2,322. Just solid number, so we can have it. But overall, this number should be something like equals to technically 305 minus 2,322. Make sense? So let's continue on this. That was problem number 1, which I did show you the answers on the Word document. This is the Excel version of it. Now we have to go to look at problem number 2. So let's look at the problem itself first. So here is problem number 2. It says the commerce company provides you with the following information. In December 31st of 2018, ending inventory of 600 units. Okay, very good. So that means in January 28th, we bought 700 units. And then in January 28th, we freight for purchase. We paid for the shipping, $500. October 5th, in 2019, we purchased again 900 units at different price. And in October 9th, we returned 200 units which we purchased in here. Okay, so we have a beginning and then we purchased and returns few times. On December 31st of 2019, there are 1,200 units on hand. So that's end inventory. Because of physical count, we know that's how many units are left. Using the weighted average method, what is the cost of goods sold on company's 2019 income statement? So remember, we have to do BAASE, beginning, added, available, subtract, end. So the beginning, it has 600 units at $8,800, which came from last year balance sheet right there. Then we purchased 700 units in January, including $500 shipping. So that ends up to be $16,600. 900 units again purchased in October. So that is $22,500. So total purchase so far is $47,900. However, we returned $5,000 of inventory. So 200 units has been returned, total cost of $5,000. That's a minus. So 2,000 units available for sale. How do we know that? Because it is 600 here, plus 700, that's 1,300, plus 900, that's 2,200, minus 200 here, that's 2,000 left available for sale. Okay, so 2,000 units available for sale at the total cost of $47,900 minus $5,000 return. It's $42,900 available. Ending inventory is 1,200 units, right? 1,200 units ending inventory. So what is the cost of goods sold? So how do we know what is ending inventory? Ending inventory is $42,900 divided by 2,000 units. It gives us an average cost. Weighted average of 2145. 2145 times 1,200 units left at the end. That means our ending inventory is 25,740. So if the ending inventory is 25,740, then our cost of goods sold is 17,160. Available less ending inventory equals cost of goods sold 17,160. Okay, now what I like to look at is the Excel. The same thing, but Excel. So here we go. So here are the January 1st layer, which is 600 units, $8,800 total. And obviously the average cost is 8,800 divided by 600. And that's the formula. Okay, and how do you know 8,800? That's given to you from last year balance sheet, okay? In January, you bought 700 units at $23, which if you multiply, that's 16,100, and that's the formula. In January 28, also you paid another $500 for shipping, which will be added to the cost of the inventory. We also purchased another 900 units at $25 cost, and based on that formula, we have $22,500. But we returned, that's a minus, 200 units at the average cost of 25 from this purchase of October 5th, and that will be $5,000, which is 25 times 200. If you add them up, you will see that you have 2,000 units left. 42,900 is available, and ending inventory will be 1,200 based on the physical count. And we know that the average cost is what? let's take the decimal to 4-digit. That's the average cost, right? So 21.45. And that will be 21.45 times 1,200. That's 25,740. Therefore, the cost of goods sold will be 800 units that is sold, which is 2,000 minus 1,200 is 800. And 800 times average cost, that gives you the cost of goods sold. And total will have to be 42,900, which, as you see here, it is 42,900 right there. Okay. Let's go to number 3. In number 3, Richco starts up in 2019. So again, it's a startup. That means the beginning inventory is 0. The company makes the following purchases. In January through December, they purchased several times, and unit costs are not same, so are changing constantly. And the total cost of those purchases is just multiply 16 times 700, 17 times 2,600, and so on. So you have all those total costs. Richco 2019 year-end fiscal count says you have 2,600 units left on hand. Okay. So you know what's your ending inventory. If Richco used the weighted average costing, what is the 2019 goods available for sale? At this weighted average costing, the company has to choose that on the very first day they start a business. Some of them, they like to do weighted average. That's good. Some of them, they like to do FIFO, first in, first out. That's also open option. And some of them are doing LIFO, last in, first out. Last in, first out is not available under International Financial Reporting Standards for companies outside US, but it is available for US companies. So this company likes to do weighted average. So they cannot flip-flop, remember that. They choose something and they have to stick to it. They cannot say, oh, this year we do weighted average, next year we do FIFO. It's not like that. You have to choose one and you stick to it. And even IRS wants to know what inventory count costing you are using, like weighted average or FIFO or LIFO. So everyone knows what you are using, and that's what you have to use. Okay, so what is the 2019 goods available for sale, ending inventory, and cost of goods sold? So it's the same story again. So if you look at the solution is here given to you. But just to make it simple, goods available for sale, you have to know what you have. So it's beginning plus added. Beginning is 0 plus added all these dollar amounts. So available is 29,430, right? And how many units do you have available? Again, beginning is 0 plus all those units that you purchased. So you know it's 13,900 units available. So average cost will be dollar amount divided by units. And that gives you your average cost. Now that you know what the average cost is, just go ahead and calculate your ending inventory. So average cost times units left, that gives you your ending inventory. Ending inventory, less available of 293,000 gives you cost of goods sold. So ending inventory less available gives you cost of goods sold. So if I show you the same thing in Excel, it should be something like this, I believe. Here we go. So you have all those units that you purchased. Beginning units are 0 because it's a brand new company. You multiply them with the cost and you get the dollar amounts, right? And then you add them up, you get the available. Available divided by units gives you the average cost. So average cost, if you add the decimal, you will see that's the average cost. Okay. So the average cost is 21,1079. Now, ending inventory, you know already 2,600 is left. So 2,600 multiply with the average, and the average in this cell equals to that cell. Okay. And that gives you the ending inventory dollar amount. Ending inventory dollar amount minus total available gives you cost of goods sold. Make sense? So this number multiplied by this number, ending inventory less 49,400 gives you cost of goods sold. Cool? Okay. So that's number 3. Let's go to number 4. For number 4 says Primeco started operation in July. So it's a brand new company again, and uses moving average. Moving average, that means they are doing perpetual method, okay? Perpetual method. And costing under the, oh, here, it says perpetual method right there. Even if it doesn't say perpetual method, I know already it's perpetual method because it says moving average. Got it? Transaction from July through October R. Okay, so in July we purchased one time. In August we purchased again. In August 21st we sold. September 11 we purchased again. October 11 we sold again. October 15 we sold again. And it says prepare the journal entries that should be recorded for these cells. Okay, so the journal entries are if you are purchasing something and it's a perpetual. So first of all, you do debit inventory because it's perpetual, and credit, let's say accounts payable or cash. So debit inventory to purchase, and credit cash or credit accounts payable. Again, same thing here. Debit inventory and credit accounts payable. But we are doing to see what's the journal entry for sales. If you are selling under perpetual method, not only you have to do the one journal entry that you'd always do, either in periodic or perpetual, but also you need to do one more journal entry, which is the second one, which is recognition of cost of goods sold and inventory. So this is how you do the journal entry: debit accounts receivable, credit sales, and then second journal entry, debit cost of goods sold for whatever the dollar amount is, and credit inventory. Cool? That's the journal entry. The dollar amount, here it's showing how to calculate it, but I would like to go to Excel to show over there. Here you can see the copy. You can stop the recording when you are looking at the recording down the road. But I'm going to just emphasize this on Excel because specifically this is moving average, and moving average is much easier to understand on Excel. The second journal entry is the same thing again. You debit accounts receivable, you credit sales, but because it's perpetual, obviously you have to do a second journal entry, which is updating your cost of goods sold, debit cost of goods sold, and reducing your inventory, which is credit inventory. So this is the journal entry, okay? And the dollar amounts, again, we will see on Excel. Here is the solution anyway, but we will look at the Excel. And here is the last journal entry for sales. Again, you debit accounts receivable, credit revenue, and you get that. And then the second journal entry, because it's perpetual, cost of goods sold needs to be increased, and inventory goes down. That's a credit. Inventory credit, cost of goods sold debit. Okay, so this is the so-called the answers on the Word document that I'm showing you, but I like to show you the same thing on Excel. So let's go to Excel, which I gave you the copy already in your module. So here we go. This is how I like to do it, okay? Kind of on Excel. So I'm gonna draw a table like this and put date, purchase, cost of goods sold, and balance, and then sales price here. That sales price can be in between, can be there, doesn't matter. Okay, so here is the purchases. We purchased 2,000 units, and this is a brand new company, so there is no beginning, okay? So we purchased 2,000 units at $8, right? And that's the cost. You see the formula? So what's the balance right now? Zero balance plus now 2,000 at $8, and that's $16,000 cost. Then we go in August 2nd, we purchased again 800 units at $10 each. So multiply 800 times 10, and that's $8,000. Now that unit will be added in here. So it will be 2,000, okay, plus 800, that's 2,800. Here will be 16,000 plus 8,000, okay, 16,000 plus 8,000 ends up to be $24,000. $24,000 divided by 2,800, and that gives you, here is the formula, 24,000 divided by 2,800, that gives you an average cost of $575, and you just make sure that is 4-digit. Okay, so far so good. Then in August 21st, you sold something. Let's say you sold it for $11. So you sold it for $11 and 900 units. So you sold it for $11, and that's 900 units times 11, and that's 9,900. Okay, we sold it at $11 each times 900 units sold. That's 9,900 sales revenue. However, what is the cost of goods sold? So cost of goods sold is 900 units at an average cost of what? 8.5714. So that's that number. So average cost, which is coming from here, times 900 gives us cost of goods sold of $7,714. Okay, so what is left? The left is you go to that cell, you say whatever was at the top, which is 2,800, divided by 900. I mean 2,800 minus 900 sold, 1,900 units left at an average cost of $8.5714, and that gives you $16,286 left. Okay, and that's $16,826. You can also technically calculate that by saying that was available, less cost of goods sold, that is left. And that is 1900 times the average cost. Same number. Then you go to September. In September, we purchased another layer, 1,000 units at a different price, $9. And that gives us $9,000 based on this formula, which is 1,000 times 9. So 9,000 is added. That 9,000 will be added in here. So we go to this line. We say this line equals to whatever we had before, which is 1,900 units, plus 1,000. That gives us 2,900 units, right? 2,900 units. How much is the total cost? Total cost now is equals to 16,286 that we had before, plus 9,000 that we added here. That's 25,286 available cost of inventory. So what would be the average cost? So the average cost would be 25,286 divided by units available, and that's average cost of 872. All you need to do is just make sure that is 4-digit average cost. Okay, and save it again. Okay, so now we know what the average cost is. All of a sudden, we sold something. If you sell 400 units at $14, so that's 400 units at $14, and that gives you $5,600 sales price. So sales is 400 times 14, and that's your sales, $5,600. But what is your cost of goods sold? So the cost of goods sold is 400 units that you sold, and that's multiplied by what? By this average cost. So if you click here, you see that is I-55. I-55 is that line right there. So 400 times average cost, which is moving average, gives you the $3,488, which is multiplying 400 times 8.72, right? That's the formula. So that will be 3,488 cost of goods sold, which you need to do again the journal entry, which again, I did show you what the journal entry is. So journal entry is 2 journal entries, recognition of the sales price and recognition of the cost of goods sold. And here was the journal entry. Recognition of sales and accounts receivable, and recognition of cost of goods sold, and reduction in inventory balance. Next one, we have one more cost of goods sold. We sold another 100 units at $15 this time. Very good. So 100 times 15 gives us $1,500 sales, and here is the formula. But what would be the cost of goods sold? The cost of goods sold is 100 units multiplied by the average cost. And what is the average cost? The average cost is still the 8.72 whatever, right? So make sure that is also 4-digit. Okay. So $100 times that number, I-56, you see that? Gives us a total cost of goods sold of 872. And what is left now? So here is 2,500 units left. Why is 2,500 units left? Because we had 2,900, we sold 400, now we have 2,500, and that's the formula. Now, we had 2,500, we sold 100, that means we have 2,400 units left. The average cost comes down, is the same average cost, So 2,400 times the average cost gives you the balance at the end. So ending balance is 20,926 ending balance. 20,926. Okay. Cool. Okay, let's go to section 4, number 5. So in number 5, it says the company uses moving average, that means perpetual. Its 2018 ending inventory is 900 units. So we start with 900 units that have an average cost of 1220. Okay, so we know what is the starting inventory on January 1st of 2019. Transactions during 2019 are as follows. So we purchased few times, we sold few times, and it says prepare the journal entries that should be recorded for 3 sales. Remember, it's perpetual. That means we have a software doing this for us. Here, we are trying to do it with Excel because we don't have actual software. But if you have a QuickBooks, let's say, then the software will do perpetual for you. And I think the QuickBooks desktop is using, maybe moving average. But QuickBooks Online is doing FIFO. If you want to do, let's say, anything else, you have to purchase additional app to do the other way. Let's say if you have QuickBooks Desktop doing, let's say, average, and you like FIFO, so you have to add another app to it, so it will change it to FIFO for you. Otherwise, by default, QuickBooks Desktop, I think it's average and moving average, and QuickBooks Online is FIFO by default. Okay, so bottom line, you need to have a software. That's what software do for you. But here we are trying just to learn what's going on and what software is doing for us. So perpetual, prepare the journal entries that should be recorded under perpetual method for these 3 sales. So the first one, again, you record accounts receivable and sales. That's a debit receivable, credit sales. And immediately the second journal entry will be cost of goods sold debit, inventory credit. The dollar amounts we have to calculate, and you will see. So, okay. For the second journal entry, same thing. You have to debit accounts receivable and credit sales. And the second journal entry to recognize cost of goods sold, which is debit, and inventory credit to reduce the inventory. So in the second journal entry, cost of goods sold will increase, and because you sold it, then your inventory will decrease. The third journal entry is same thing again. You record the sales, that's a debit receivable, and credit sales revenue. And then in the second journal entry, you debit cash to increase the cost of goods sold, and you credit inventory to reduce your inventory. Okay. Now, it says, what does the company reports as ending inventory on its balance sheet? So obviously we have the answer here, but I like to show you the Excel. So here we go. So in number 5, we have the beginning inventory, January 1st, given to us. It says 900 units at an average cost of, let's say, $12.20. And we have total of $10,980. But in February, we purchased 1,200 units at $13. And that's the math. 1,200 times 13. And formula is right there. So now you have to add. So you go to this cell, you say 900 plus 1200, that's 2100. Then you go to this cell, you say equals to 10,980 plus 15,600 is 26,580. Then you go in the middle and you say equals to 26,580 total cost divided by total units, 2,100. And there you go. You have $12.66, which you go with 4 decimals. And there you go. Very important to go for 4 decimals. Okay. But in March 1st, we sold 1,500 units. And we sold it on $22 each. So sales price is, here is the formula. Sales price is $22 times 1,500 units sold. And that gives us $33,000 sales revenue. Yes? However, the cost of goods sold is 1,500 units at an average cost of $12.66, which is that number. Multiplied by 1,500, its total cost of goods sold of $18,986. $18,986 is the cost of goods sold. So what is left? Left equals to available of 2,100 units minus 1,500 units sold. That's the formula. And that gives you 600 units left. At what price? At an average cost of $12.66. And the dollar amount here is whatever we sold here, 26,000. I mean, whatever we had here, 26,580, right? Less cost of goods sold gives us 75.94. And that's the average cost, which I like to see it in 4 decimals. And 600 units left. But in May, we purchased again 300 units at a different price of $14. So that cost is 4,200, and that's the form. Therefore, all of a sudden, we have equals to 600 units here plus 300 units here equals to 900 units available. And $7,594 cost plus 4,200 ends up to be 11,794. That's the formula. 11,794. You go in the middle. You say 11,794 divided by 900. And that gives us $13.10 average cost. And that's why we call it moving average, because it's changing constantly, and we go 4 decimals on that. Cool. Then in 400 units is sold at $25. So the sales price is 400 times 25. What is the cost of goods sold? The cost of goods sold is 400 times the average cost of 1310. So 400 times average cost of 1310 gives us $5,242 cost of goods sold. So what is left? We have 900 less 400, that's 500 units left. That's the formula. And the average cost is 1310, the same dollar amount. And the balance is 6552, and that's the formula. So 6552, you can say it's available 1174 minus cost of goods sold. Here is 6552. In November, we purchased 500 units, another layer at $11 this time. And that gives us $5,500 cost of purchase of new inventory. So inventory previously was 500, right? So now we go here, we say equals to previous balance of 500 plus this 500 that we just purchased. It gives us 1,000 units. And the total cost was previous cost plus this cost gives us 12,052. So previous cost plus new cost is 12,052. 12,052 divided by 1,000, that gives us the average cost of 12,0524. Then we sold 600 units at $35 each. So 600 times 35, it's total sales of 21,000. And here is the formula. What is left? So 1,000 minus 600, it's 400 left. What is the cost of goods sold? 600 times average cost of 12.05, whatever it's in here, gives us 7,231 cost of goods sold. And the leftover balance is 12,052 less cost of goods sold, gives us $4,821 at an average, moving average cost of 12.0524 and 400 units left. So what is ending inventory balance? 4,821. And here is the ending one balance. So you might say, oh, wait a moment, how come this one shows 4,820? The reason this one shows 4,820 because it's not that much accurate. The Excel is much more accurate because we are going with 4-digit decimal. Make sense? And we are calculating constantly what is left. So what is left? The left is what was over there, 12,052 minus cost of goods sold, and the left is $4,821. That is the exact number. And then what is the average cost? That is the exact number. 4-digit, 12.0524. Okay. So let's go to number 6. On January 1st, the company sells clocks, whatever, had units on hand that cost $14 each. And its 2,000 transactions are as follows. So in January 1st, we have 40 units at $14. But down the road, we purchased few times, we sold few times. And it says, A, the periodic method and weighted average costing. What is the ending inventory under periodic and weighted average? So you have to calculate it, and it will be different answers, okay? So you do periodic ones, and then you do weighted average costing. So here is the weighted average costing answer. So ending inventory is 1,310. Okay. But this is the perpetual costing, which takes longer time. And in ending inventory is 1,380. So 1,380 compared to 1,310. So it's different. Okay. How do we do that in Excel? Here is the answer on the Word document, but let's look at the Excel. Okay. Under periodic, you have the beginning January 1st balance of $14 each multiplied by 40 units, that's $560. And you purchase three more times, you multiply each time, and then you add them up. So you have 4,340 total inventory cost available, total 265 units, and the average cost ends up to be 4,340 divided by 265, and that's 4-digit. There you go. $16.37. Very good. Now, what is the ending inventory? Ending inventory is 80 units at the average cost of 1630, let's say 0.3774. And that ends up to be $1,310 ending inventory. Therefore, the cost of goods sold will be 4,340 minus 1,310. It's 3,030. Okay, and that gives us the total 4,340, which is equals to that. Now, those two numbers has to match. So you see available here, and when you say ending is this and cost of goods sold is this, that if you add those two numbers has to match. Okay. Cool. Now, the same thing, if you like to do periodic, you have to do this table. Okay, so the table is beginning January, we have 40 units at 14, and that gives us $560. We purchased 60 units at $15. We multiply that, that's $900. That $900 will be added to 560, and that gives us 1460. So 900 plus 560 is 1460. That's the formula. And 40 units plus 60 units equals 100 units. That's the formula. And then we go in the middle and we say that number, 1460, divided by 100, and that gives us 1460 with 4-digit decimal. Then we sold 70 units. 70 units times $25. That's the sales price. 70 units times average cost. That gives us 1,022. So the average cost is this, multiplied by 70. That's $1,022 cost of goods sold, and that's the formula. So what is left? Equals to 100 units less 70 units, enter, that's 30 units. How much dollar is left? 1460 available less 1,022 is $438 left. And average cost is still the same. In May, we purchased 90 units at $17. That's $1,530. $1,530 will be added to $438, and that gives us $1,968. $1,968. How many units? Beginning units is 30 plus 90 purchased. That's 120 units available at that point. You go in the middle and you say 1968 divided by 120. That's 1640 average cost, and here is the decimal. Then you sold 55, multiplied by average cost of 1640, gives us $902 cost of goods sold. Sales price is $29 times 55, gives us $1,595 sales revenue. So what is left? Available is 120 less 55 sold. That's end at this moment, 65 units. And the cost is 1968 less cost of goods sold is 1066, and that's the average cost. However, in September, we purchased another 75 units at $18. So 75 plus 65 equals 140. That's the formula. You go to this box, you say equals to 1066 plus 1350 is 2416, and that's the formula. Then you go in the middle, you say the dollar amount divided by number of units gives us moving average of 1726, and you go 4 decimals from here, and there you go. Then you sold 60 units times average cost 17.2571 gives us cost of goods sold of 1035. 60 units times $28 gives us the sales price of 1680. And the leftover is equals to 140 here less 60 sold. That's 80 units left, and that's the formula. And you go to the end here, you say 24,116 minus 1,035, and that's $1,381 ending inventory balance. Total cost of goods sold is also available here. If you want to add up total sales, you can also calculate here. That's total sales. Very good. Okay, that's section 4. Let's go to section 5, which is FIFO. In section 5, we are using inventory costing, FIFO method. FIFO, again, can be in periodic or perpetual. If it's periodic, it's easier. If it's perpetual, then you need a software because it's constantly changing. Okay, so the company starts up in 2018, so it's a brand new company. That means the beginning inventory is 0 and decides to use FIFO costing under the periodic method. During 2019, it makes the following purchases. So we purchased in January, April, June, August, September, December. We purchased all those at different prices. So company in 2008 year-end fiscal count had 4,000 units that cost $60,000. In 2019, fiscal count shows 2,600 units. So the company starts in 2018. At the end of 18, they end up to have 4,000 units with a total cost of $60,000. However, in 2019, ending physical count shows 2,600 units. We need to figure out the cost. So what is the company's 2019 ending inventory? Here is how you calculate the cost. And what is the cost of goods sold? Cost of goods sold is available minus end gives you cost of goods sold. So here is the answer, but I like to show the section 5, FIFO, problem number 1. So we have all these purchases that was given to us. The beginning was 4,000 units, total cost of 60, but we purchased again and again and again. So total 17,200 units are purchased, and the total cost was $345,300. So we are doing FIFO, first in, first out. So let me write here FIFO so we can kind of emphasize that here. Okay, so we are doing FIFO. Under FIFO, remember, first in, first out. That means this layer is out, that layer is out, that layer is out, that layer is out, that layer is out. So whatever is first is already out. Okay, but what is left then? The left is 2,600 units. Make sense? So first in, first out, the top is gone. Those are all gone. But 2,600 units is left. So you go from the bottom of it and pick up 2,600 units. So if you go to the bottom, the first bottom layer is this purchase. So that is left right there. Okay, you copy that in here. So this is that. So this equals to that. Enter. This cost equals to that cost. Enter. And that is multiplying these two numbers, which is 24,300. But that's not enough, right? You need 2,600. 900 is not enough. So because 2,600 is not in layer 1, you go one layer up from this September 5th layer, and you pick up the rest from there. So you go here, you say equals to 2,600, which is that number, minus that 900 that we already cut it from December. And okay, let me just change that. So here you go to 2,600, that's 1,700. Instead of typing, you say you know that you did a physical count and you have 2,600 left. So you have to type that. So if you type this, you know it's 2,600 left. Okay, but how much do you need from September? You need from September equals to what is left, 2,600 minus 900 that you took from the layer, and that's 1,700. So now that is a formula. That comes from here, okay? 1,700. But at what price? Equals to that price, $25, the layer of September 5th. Enter. So that's 25. So 1,700 times 25, that gives you 42,500. That's the formula. Okay? And now you see that 2,600 is the end inventory. The total cost is $66,800. That's your ending inventory. Now the ending inventory, at this point, you can say, okay, what is my ending inventory? Anyway, this is the layer that goes to the next year. Make sense? This is the layer that goes to the next year. So you say ending inventory is 2,600 units at 66.80. At this point, you can say what my average cost is if you like, because it's good to know that how many units you are taking to the next year and what's the total cost, how much is your ending inventory, and that's the balance. If you like to know the average, you can say equals to that number divided by number of units. Enter. That's your average cost, and that's good to know. Your average cost is about $25.69. Okay, that's good to know. But what amount goes to your balance sheet? 66,800. How many units do you have? 2,600. What's the average cost? About $25.69. Okay, that's good. But what's your cost of goods sold? So the cost of goods sold is what is available. Available is 17,200, right? 17,200 minus whatever is left, 2,600. So you know that you sold 14,600 units, but the cost is $345 available less end inventory value of 66,800. That gives you cost of goods sold of 278,500 cost of goods sold. Okay. You don't honestly need to know the average of that. Doesn't matter. Who cares? So you can easily say, I don't care what this is. But what is the cost of goods sold? Bottom line, the cost of goods sold is 278,500. That goes in the income statement. 66,800 goes in ending inventory in the balance sheet. How many units do you have at the end inventory? 2,600 units. What's your cost of goods sold? 278,500. That's FIFO using average method. Let's do section 5, problem 2. Section 5, problem 2 says, Calco uses FIFO under the periodic method. And the inventory records are the following. Beginning was 120 units at cost of $10. Remember here, when it says at the cost of $10, this 120 is not probably just one layer. It might be, coming from different purchases, whatever it was from last year, but the average cost is $10. That's what it is. But they purchased few times. Okay, they purchased few times and at different prices. Okay. At the year end of 2019, a physical count of inventory shows 450 units on hand. What is Calco's goods available for sale? Okay, so in units and then in dollars. In units, we know that it's 120 units and it's 450 units on hand. So that means we sold all this stuff, 1,050. So goods available for sale is 1,170. So the beginning is 120. We purchased 1,050. Available for sale is 1,170 units. How about in dollars? The beginning was 120 times 10, which is 1200. The purchases were, 300 times 12, 200 times 13, 300 times 14, 250 times 15. And if you multiply that and you add them up, is 1410. And 1410 plus 1200 is 15,350. That's goods available for sale. So units available for sale and goods available for sale in dollar. Then it says, what is the ending inventory? So ending inventory, we know that is per question says 450 is left. 450 left from where? Remember, this is FIFO. So first, that layer is gone, the next layer is gone, the next layer is gone. Those are all first layers gone. So what is left from the bottom? So go to the bottom, right there. You pick up whatever it is. But that's not enough. But take that, no problem. Take that 250. And you need 200 more, go pick up from the next layer. So 250 times 15, and 200 more from here times 14, and that will be here, 250 times 15. And then you need 200 more, go one layer up, pick up from there, that's $14 each. Multiply that, add them up, that's your ending inventory. As soon as you know what your ending inventory is, you deduct it from the available for sale, and that gives you cost of goods sold. Okay, so cost of goods sold is available less ending inventory. Now the same thing if I show you on Excel, let's see how it looks like. So here is 120 times 10, that gives us 1200. Then we purchase few times. So the ending inventory is 450 units. 450 units from where? It comes from 250 from this layer, 200 from that layer, and that ends up to be 450. We know that it's 450, right? So we can type that and we say, okay, to get to this point, 450, you need to take whatever is left from here. So this equals to that. See? And this 200 equals to that 450 that I need minus 250 that I took from there. That's 200 that I want from this layer. And this cost equals to $14. And that $15 technically equals to that $15. So at the end, I have 450. And my cost is $37.50 plus 2,800, and that is $6,550. Okay, ending inventory. So what is the ending inventory? 450, 6,550. And that, now I need an average, so I know what is my average cost. Remember here I said that is the average of whatever it was from last year, right? So here, if I want to take this to the next year, I have to figure out kind of what's the cost anyway, right? So what's the cost? I know 450 comes from 2 layers, but if I want to take it to the next year, I'm going to get an average of this. So I'm going to say equals to that number divided by number of units ending. So I'm going to take this to next year. So if I'm going to do the same thing for next year, I'm going to technically take that, and I'm going to say, oh, from last year, we had 450 units at an average cost of $14.56. which is 6,550. And then we purchased again. The same story repeats. Same thing here. So that came from last year. Now this goes to the next year beginning balance. Yes, it is this year ending balance, but it will be technically next year beginning balance. And the cost of goods sold was 8,800 units. I mean dollars, which comes from equals to available minus end inventory, enter, and that's your cost of goods sold. And units is available minus ending inventory, and that's your units sold. Got it? And this part is optional. If you want to know by any chance, what was your average cost of, every unit that you sold last year, this is it, $12.22. But that's just managerial kind of information. But doesn't go anywhere. Will not be used for anything in financial statements. Good. Let's go to section 5, number 3. Okay, so section 5, number 3 says, in 2019, the company sells 6,800 units, $70 each. Okay. It began the year with an inventory of 750 at $22 each and made the following purchases. 4 types. The companies use the periodic method, use the FIFO. What is the ending inventory? What is the cost of goods sold? Okay. So here is the answer in this Word document, if you want to look at it. But in the same time, I'm going to take this to Excel. So we know that the January 5th, we had 750 units at the cost of $22 each, and that would be the calculation. But we purchased 4 more times at different prices, and those are the dollar amounts, and then we add them up, and available is 194,700 and 7,350 units. And it says ending inventory is 550. Let me look at it. Ending inventory. Sells 6,800 units. You see, it sells 6,800. Doesn't specifically tell me what's the ending inventory units. In real life, you know what ending inventory is because you do physical count. Okay, got it? You know that is what the ending inventory is. So let's go here. And so, okay. The ending inventory is total of units that you have, which is available 750 plus 2,600 plus 300 plus 1,500 plus 2,200. That gives you the available, right? And available of 7,350 minus 6,800 sold. That gives you 550 ending inventory. Again, in the real life, you have to go to the inventory room and you have to count it. And that's how you know it's 550, okay? You're not going to do this way. Here, by purpose, they give you hard time. Other than that, you don't need to do this in the real life. In real life, you just go to inventory, you count it, and you see 550 is left. That's the solid answer and solid way to do it in accounting. So you go to ending inventory now. Let's say you got it 550. So you go to Excel. You say, okay, here I have so-called 550 left. So where is that 550 coming from? 550 is coming from the inventory, right? Ending inventory count. So we know 550 is left. I'm gonna go to the, it's FIFO. That means all these layers are, all of them are gone. All of them. First in, first out, gone. So something at the end, at the bottom is left. So go to the bottom, take 550 from the bottom. Okay. So you take that 550 from bottom. What price is that? That price, which is 30 bucks. So 550 at the bottom times 30 bucks. That gives you ending inventory value, which is 16,500. Very good. But what is the cost of goods sold? The cost of goods sold is available minus end. That's cost of goods sold. Okay. How many units are sold in a real life? You say, okay, how many units did I sell it? Let's see. I have 7,350 and I have 550 left. That means I sold 6,800. That's how you do in the real life. In this question, in this problem, they gave it to you. So they said, oh, you have available of 7,350, you sold 6,800. That means end is 550. In real life, you know it's 550. You don't, that's the only way you do it, by doing a physical count. Anyway, so now that you're going to the next year with this ending inventory, you have to figure out what the cost is. So the cost is 16,500 divided by 550, and that's 30 bucks. So that's your average cost that you take it to the next year. So this layer goes to the next year beginning balance. Got it? Next year beginning balance. Same as this one. Remember, this year beginning balance, it was given to you. Now, if I say what is next year beginning balance, the answer is that. Okay, let's go to section 4, number 4. I'm in section 5, number 4. Okay. Here's the problem. The company is using a perpetual method and FIFO. Here is the 2019 inventory records. The beginning inventory is 800 units at cost of 50 bucks, and that's $40,000. However, we purchased a few times, we sold a few times, and we are using perpetual. That means we need a software. Of course, we don't have a software here in this situation, so we're gonna do it manually ourselves, right? So it takes a little bit longer time. So here we go. It says present the journal entries for each sales of cost of goods sold. We're gonna calculate those cost of goods sold, but here is the answers anyway. So for cost of goods sold, not only you have to record the sales revenue, which is debit accounts receivable, credit sales, but also you need to do debit cost of goods sold, credit inventory. Same thing on the second sales. Debit accounts receivable, credit sales, and debit cost of goods sold and credit inventory. So it gets adjusted. Again, for the third sales, the journal entry number 1 is debit accounts receivable, credit sales, and cost of goods sold debit and inventory credit. Now, how do you do these numbers? Let me show you on Excel. It's easier. Here is the Word document answers, but I like you to see the Excel. So here we go. We had the beginning inventory already. We purchased another 1,000 at 52.50, and that's total cost. Now 800 plus 1,000 becomes $1,800. 1,800 units at that moment. Okay, at that moment. And the total inventory at that moment is 92,500. But because we are using FIFO, so we have to keep these layers separately. Okay, we're not going to calculate the average. Got it? Why? Because this is FIFO. You see here it says FIFO. That means we have to keep these layers separately. On May 25th, we sold 900 units. Okay, very good. You sold 900 units. But where is that 900 units coming from? Because this is FIFO, here says FIFO, right? So the first, you go to the first layer here and pick up 900. Do you have 900? No. Okay, pick up whatever you have. So pick up the whole thing and copy it in here. Got it? Yeah. That comes from here, right? Okay, see that? And that's not enough. You need another 100, right? Because you sold 900, right? So you need another 100. So you take that another 100, but the cost is different. So here is $50 that comes from here. And we have $52 that comes from here, $52.50. And then you multiply them. And then you add them. And that will become your cost of goods sold. Got it? Now, then what is left at that point? At that point, you have 900 left, which is 900. That means 1,000 minus 100 equals 900, right? So far, so good. 900 left. And what's the cost? That the cost is $52.50. And that's the dollar amount. 900 times $52.50, that's the dollar amount. However, just a few days later, in August, we purchased another 1,000 units at 55, and that's the cost. That 1,000 will go added to the balance. So it will be that $1,000 here. Okay, 1,000 units, I mean. 900 plus 1,000, that's 1,900. Okay. So that 1,000 equals to that 1,000. Enter. The cost equals to that cost. Enter. And the total is literally, technically, we can say equals to that number multiply by that number, enter, 55,000. So now how many layers you have? You have 1,900 units coming from these two layers, and the total cost is $102,250 coming from those two layers. That's so far so good, but you sold 1,500 units. Okay, where is that 1,500 units coming from? 1,500 units, you go from first in, first out. Remember first in, first out? Do you have the first layer 1,500 units? No, you don't. That's fine. You pick up as much as you can. You say equals to that 900, enter. That's fine, but that's not enough. You need another 600, right? So you get another 600 from that layer. Okay? 600 from that layer. But what's the cost? 52.50 is that cost. $55 is that cost. And then you multiply. So 900 times 52.50. And then 600 times 55. And then add up these two. Ends up to be $80,250 cost of goods sold. Okay, you sold it. Good for you. What is left? This 900, that's gone. Out of this 1,000, 600 is gone. So 400 is left at $55. 400 at 55. That 55 comes from here. And that's the total dollar amount. However, in purchase of November 16, we had 1,500 units purchased at $56. That's the total cost. Now that will be transferred here. Okay. Which is equals to that number. Enter. And then you add them up. The average cost is 84,000, which is coming from here, divided by number of units, 1,500. That gives you $56 average cost, which is exact same thing. Then you add them, 1,400 plus 1,500, that's 1,900 units. And the cost of $22,000 plus $84,000, that's $106,000 at this point. However, in December 11, we sold 1,000 units. 1,000 units, that's first in, first out. So I go to the first layer, I want 1,000 units, but it's not enough. That's okay. We pick up all of it. And you say equals to that amount. And the cost is equals to that layer. And that's the total. Okay. Then you go the rest, you count, bring it from here, 600 units to make it 1,000. The cost is $56, and that's the multiplication. And then you add them up. That's your cost of goods sold. Now, what is left? The top layer is gone. From the second layer here, you have 600 units gone, right? So just 900 is left. 900 at $56, right? And that's the total cost, 50,400. Make sense? So ending inventory is 50,400, 900 units left. That's the average cost. Cost of goods sold, 3 items here. If you add them up with the total cost of goods sold that goes in the income statement for financial statements, but you have to journalize them. And I did show you the journal entry here. Sales number 1, sales number 2, and sales number 3. Okay, that's section 4 and 5. We are done for today. Okay, if you have any questions, again, you can stop by on my office hours. Have a good day.